Well, hello everyone. Again, this is Joseph Trevisani from Worldwide Markets Online Trading. We've decided here that we needed to add online trading to our name because Worldwide Markets is pretty generic. Today's topic is the Fed and quantitative easing. In fact, this is probably the only topic. I know most of you have heard me talk on this several times before. But once again, we're on Fed Watch. Both for Janet Yellen's, the new chairman-designate's hearings in the Senate tomorrow, and once again for the Fed decision at the end of next month. A few notes before I get started. Once again, I'd like to thank FX Street, Maud Gilson, Adinda, and everyone else who's there, and of course Francesca for founding the company 15 years ago, for giving me this opportunity to talk to you all. I thank you all for coming. It's a compliment to me and to FX Street that people will take out their time to listen to what we have to say here. So again, I thank you for coming. And lastly, I like to put these on as a colloquium rather than a lecture. If you have any comments, pretty much on anything except maybe music videos, please type them in, and I will either answer them immediately if they're appropriate to what I'm talking about at the time, or I will answer them all throughout the webinar. I really think that these things are much more effective for everyone, for myself included, if we do our best to talk back and forth, given that I'm the only one with a microphone. I know that's a little bit difficult. So please use the chat. If you have anything to say, say it, and I'll do my best to answer it. Almost any topic is okay, as I said, except, well, do anyone watch music videos anymore? Okay, on to our topic, the Fed, quantitative easing, and what is cooking these days in the markets. The Fed is the world central bank. We may not view it as such, and I try it not to be a parochial statement here from the United States. Remember, I live in Manhattan, which is the most parochial place on the planet. People who live in Manhattan have a tendency, I suppose, like many people in Paris and other capital cities around the world, although it's not quite a capital, to think that the world revolves around them. It most assuredly does not. But one thing that is true is that because of the size of the U.S. economy and the activity of its central bank, the Fed, the Federal Reserve, under Ben Bernanke and going back many generations, and under Janet Yellen, we assume, in the new year, is the world central bank. Its policies have more effect on the world than anything else. When the Fed loosens rates and drives out money to support the economy, the effect is not simply felt from California to New York and up to Alaska and down to Texas. It's felt in emerging markets. It's felt in China. It's felt all over the world. So what the Fed does is key to the monetary policy effects around the world. I'm going to start off that I have a number of charts, not that many, as you know, I don't rely on charts too much. I speak more than I rely on charts. The Fed's quantitative easing policy is treated as they would say in Latin, a sui generis. That means its own genre of policy. And it both is and is not. But by and large, for the immediate effect of the policy, it is not sui generis. It is monetary policy. Or as someone an article I was reading by Kevin Warsh today, and the way he puts it is this: he's a former Fed governor and now teaches at Stanford. Quantitative easing is nothing but the normal conduct of monetary policy at the zero lower bound of interest rates. That's as succinct as you can get. It affects the world because it has, at this particular run, two ways. First, it makes other central banks competitive with it. Competitive devaluation is something we all understand and know about. And you could see the ECB was the latest participant in this. They just dropped their rates, surprised everybody a quarter point. So it tends to set policy. Second, it tends to drive investment. If there is very little, the United States is still the greatest source of capital. And it drives capital in search of return. We looked at last time, or maybe it was 2 times ago, I forget which, the change in valuations for various emerging markets currencies. We primarily looked at the rupee and the Brazilian real. Those moves in both their stock markets and in their currencies were driven largely, at least on the margins, and the margins are what drives markets, of course, by the search for return by various investors. So both of those things have great effect on capital flows, on investment flows, and also specifically on markets and trading flows. In fact, the greatest effect of this particular policy has probably been on markets. That's partially by design and partially by default. Quantitative easing, who did christen a quantitative easing? It may come to me. I don't remember offhand. And I can't use my computer because otherwise I can check it. Somebody, if they're interested, can just run it through Google and see who comes up with the word. If you run it through Google, you'll have to do, I guess, quantitative easing origin or something like that. So, quantitative easing is Fed monetary policy at the lower bound. Why lower bound? Here we have the logic, of course. The Fed reduced under Bernanke rates to 0.25% back in the latter part of 2008. We're now running 5 years. I don't know when exactly the anniversary is. It's probably right around now. We're now running 5 years at 0.25 and an effective rate lower than that. Once the Fed has done that, it negates, by and large, the effectiveness of interest rate policy. Traditional interest rate policy determined by rate cycles of the central bank's key rate. In this case, the Fed funds rate. In the ECB, the main refi rate, and on and on and on. I forget what the Brits call it. The Australians call it the cash rate. Those rates can no longer be adjusted to affect the economy, monetary policy. So the Fed, by that standard, had run out of bullets, out of ammo. What do you do? So the Fed invented this policy. It has been, and this is my point for these charts. Look at these two charts. The one on the bottom is the Fed funds target rate. That's the 0.25 rate we're seeing now. The reason I chose the target rate rather than the effective rate because it's much clearer. There's a lot of noise on the effective rate chart. And this is the 10-year. Probably the most important rate in the world for setting market interest rates. More rates key on this, I think, than almost anything else. Certainly U.S. mortgage rates and on and on and on. Now look at the congruence in the two rates. It's a rough congruence. It is by no means a step-to-step equivalency. The Fed doesn't do something and the market responds. This is also a key to the origin of quantitative easing. The Fed funds rate is a guideline. It is something that traditionally and historically the markets have followed but not obeyed. At the zero bound after 2008, with the economy in the absolute doldrums or worse, and Mr. Bernanke and the Fed very worried about deflation, waiting for the markets to do what the Fed wanted them to do was not something they were willing to chance. So what they decided to do, and this is there are a number of interesting aspects and original aspects about quantitative easing. One is how it's affected, and two, the potential dangers. But let's deal now with how it's affected. When the Fed, historically, changes interest rates, that's what it does. It changes the Fed funds rate. Usually, after a period of low rates, it is designed to be a counter-cyclical policy. That means if the economy is going into recession or weakening, you lower rates. And if the economy is strengthening, or getting too close to inflation or overheating, you raise rates. Its purpose is to dampen the cycles and perhaps cut off the extremes. That's its purpose. But again, it's affected by having the market follow the Fed's lead. The Fed doesn't force the credit markets, the bond markets, to change rates, or it hadn't anyway, up until this point. And for the Fed, the problem with these two charts was the resistance of the Treasury market to take a large dip below historical norms. So look at this chart here. Now remember the situation when the Fed starts QE. I mean, they've gone through 3 terms now, so we can talk about them all the same, because they're all of the same, they all work the same way. If you look at the historical rate, this is when Volcker in the early days, who was actually appointed by Carter, not by Reagan, started raising rates to squelch off the inflation. Where did the inflation come from? Well, the inflation came from Lyndon Johnson and other administrations after that, who both ran the Vietnam War and started the Great Society programs and decided he didn't have to pay for them. And so that's where the great inflation of those days got started. Then it was continued by subsequent administrations, which Volcker then raised rates to squelch out inflation. Inflation has a great anticipation component. That's a psychological component. It's not a factual component. And one of the things that Volcker did, he's still around, he was used, sort of trotted out in the early days of the Obama administration to give sort of credit or weight, gravitas, that Latin word, to the administration's economic team. He never really participated very much, but they used to trot him out every now and then to say, hey, look, we're here with the big old guys. And he is a very tall man, actually. Anyway, So the problem for the Fed in the fall of 2008 and subsequently was that it did not believe that the markets would drive Treasury rates, no matter where it put the Fed funds rate, would drive Treasury rates low enough for the Fed to feel they would be an aid to the economy. The Fed had already done all it could. It dropped it to 0.25. What's it going to do, pay people to borrow money? I suppose it could, but it didn't. Maybe there's something against the law about that. I don't know. So if you look at the historical averages on the 10-year, it looks very much, even if you cut off the Volcker years and you start in 1990, it looks very much like the 10-year rate, let's be generous, averaged 4%. It's 2.77 yesterday. I'm not sure where it is now. It was down to 1.63, I think, at some point. The Fed looks at that and it says, this is not going to help. A 4% rate is going to be a huge drag on the economy. What do we do about it? We can't. Okay, I'll answer that question right now. It's because the lack of return in the United States simply, and in other places, simply drove money overseas looking for better returns. And you historically get better returns. You also get worse falls in overseas stock markets and emerging markets. It has driven up the stock market, the U.S. Stock market tremendously. I will deal with that in a minute. I have some charts about that. Correct. What we have learned, one of the things that's fascinating that we've learned about this, actually I have this in my column, which will be published later today. And I've said this many times. Mr. Bernanke has been absolutely right. There's no inflation because there's no demand. The predictors of hyperinflation are absolutely wrong. You're correct. There is not a one-to-one correspondence between money creation, which is what the Fed's doing, and inflation. The intermediary step is loan and the loaning money and the consumer, because what the banks are doing, whoever's getting this money, they're just putting it on deposit at the Fed. They're not using it because there's no demand. Okay, so back to where the Fed was. So in the fall of 2008 and subsequently over the past 5 years, they're looking at the historical data from interest rates, from the rate that we're focusing right now here, the 10-year Treasury, and they're saying this is not going to help. The economy is facing deflation, well, disinflation and perhaps deflation. And you have the aftermath of a financial crisis from which the recovery historically takes much longer. They're also looking at Washington. And I'm not going to go on and on about that, but it must have become increasingly over the past 5 years evident to the FOMC, Bernanke, and company that nothing productive is really going to come out of Washington. And it hasn't. So, based on this, the Fed takes what is actually, as far as monetary policy goes, although it seems like quantitative easing is just, interest rate policy by another means, it is quantitatively, sorry about that, not a joke, different than previous policies. Looking at these two charts, you can see that there's only a rough congruence between what the Fed wants, as evidenced by the Fed funds rate, and what the market delivers, as evidenced by the 10-year rate. And for the Fed, in extremis in the fall of 2008 and since then, that was not enough. I think Carlos is right. I do not believe that banks are allowed to go out and buy stocks. But I'm not 100% sure about that. But they don't have to. They lend it to the hedge funds, and the hedge funds go out and buy the stocks. So it doesn't make any difference. It has its effect. We're going to talk about that in a minute. So for the Fed in the fall of 2008 and subsequently, they needed to do something. They had run out of choices with the Fed funds rate. So what they decided to do, which is why this is quantitatively different, is that they decided to intervene directly in the markets. This is not what the Fed has done before. They were buying for their own book, basically. So the Fed goes out and starts buying first MBS and then Treasuries, and it's been doing it ever since. With quantitative easing 3 or 4, depending, it is now buying $85 billion of this stuff a month. I think it's $40 billion of Treasuries and 45 of MBS. That's mortgage-backed securities. So that is where this dip comes from. Again, far below the historical norms for interest rate policy in the United States. All right, let's look at some other charts here. Excuse me. Okay. So those were the long-term charts, okay? Here's another view of the congruence of these particular rates. Okay, this is the Fed funds target, and this is the 10-year. See, even if you go to a smaller period, you can see again, these are monthly rates rather than quarterly. The other ones were quarterly. You can see that the congruence of the rates is only in the most general sense as far as if you put a median slope on both of these charts, my guess is you would get probably a very similar figure. That's the main congruence. It's not what the Fed would like. Most of the time, throughout history, actually, the history of the Fed is okay with this. But as I said, in extremis, in the fall of 2008 and subsequently, this was not enough for the Fed. Okay, let's not look at these. Let's move on to next discussion. That's the base discussion for what's behind Fed policy. Okay, now, the Fed policy is, let's put some charts up here. Hang on. Okay, I'm going to be talking about these dates as indicative of changes in Fed policy. And I think you know it there. I'll talk about the dates specifically in a second. That is the 10-year. And let's look at this one. This is the Dow with the same dates. Okay, now let me talk about the dates first so we all know the background of what we're talking about here. Okay, let's take a look at some questions here before I start on another topic here. That's right. The banks don't buy stocks, and the banks also can't create loan demand. And it is loan demand that drives, because what happens when the banks take in capital, there are two steps to money creation. One, you could say, is when the Fed buys treasuries, or usually buys them from banks or institutions. I don't hold any treasuries. I live in New York, so I live in the city, so I tend to buy tax-free bonds because of where I live. However, so it then gives the money to the bank. If it buys the treasuries from the Fed, it buys the treasuries, say it buys the treasuries from the bank, or it buys MBS from whoever holds it. It gives the institution the money. What does the institution do with the money? Well, if it's a bank, right now it puts it on deposit in the Fed because nobody's asking for it. But what it can do, if there's demand, is it then starts loaning out that money. But it loans out the money at a multiple. We all know in a banking system, and no bank ever has 100% on deposit for their liabilities. They have a small percentage. I don't know what the percentage is. It's governed by regulations. But whatever it is, there's a huge multiple effect for the bank's capital. That's where most of money creation takes place. The banks, however, are not lending right now. They're not lending for two reasons. Credit standards were tightened, but the main reason is there isn't any demand, or at least there isn't appreciable demand to create extra money, to loan out money. The bank gets in $100. They use that $100 as example. I don't know if these figures are right, as a basis for $1,000 worth of loans. So the $100 that was created by the Fed becomes $1,000 out in the market. That's the multiplier effect of money. That's how money gets, created. So that is not taking place. Okay, now you're right that the monetarist effect, which is what we're talking about, presupposes an economy in a normal condition, and this is not in a normal condition. In general, that idea of inflation created by too much money chasing too few goods is an accurate one, but it's not the whole story. And we have seen that completely. And you have noticed that some of the proponents of this from the early days of quantitative easing have gotten a lot quieter. It's tough to argue with the facts of disinflation in the face of money creation. So we've all learned something, including the central bankers and everyone else. Okay, so what dates do we have here that are appropriate for quantitative easing? May 22nd. The entire discussion about tapering, reducing the amount of quantitative easing, reducing the amount of purchase, was not something that the markets thought up or some journalists suddenly started talking about. It was started by the Fed, by Ben Bernanke. On May 22nd, sort of, it seemed at the time as an offhand comment, he said, well, maybe we're going to, I don't remember exactly what his words were, it's probably not these. We're going to stop, maybe, things keep going, we could probably, maybe stop quantitative easing. He's much better spoken than that, actually. And in truth, look at the difference in the markets, in the reaction. And we could do the same thing with the euro. If I put up a euro chart, it would show that the euro and the currency markets didn't pay any attention to this. But who did pay attention? The credit markets, the treasury market. Now, it was rising already from the low here. Part of that is probably just a reaction to regular market pressures. But look at the treasury market and look at the Dow. Pretty interesting difference. Okay, what happened is that the Dow really wasn't paying much attention, but the equities market was, but the treasury market was. And this is what you would expect. And that's true of the currency markets as well. So the conversation was started by the Fed as far as ending QE, or potentially ending QE. Now, one more thing about the basis of QE. And then we'll talk about the specifics on how its effect. Remember, the purpose of this whole conversation is to try and figure out what the Fed is going to do. Where are we going to go with policy, and how is it going to affect markets, and primarily currency markets? We'll get to that. At least I hope we will. There are three things I think that are important, three additional things that are important to remember about quantitative easing. The first is that its main effect on the market, on the economy, and Mr. Bernanke said this many times, is through the wealth effect. Very simple. If you feel like you have more money, then you spend more money. So the purpose of the quantitative easing policy is to make people feel wealthier. It doesn't create wealth. The government can't create wealth. But if it drives up the stock market, if it drives up housing prices, then people will feel more wealthy and they will spend more money. That's the theoretical. It's a weak read, but it is all the Fed has. As I said, at the lower bound, they have run out of effective monetary policy by traditional means, hence quantitative easing. The second, or actually part of that, the wealth effect, yes, without question, and I'm going to get to that. Without question, the wealth effect is effective at the margins, not at the center rationale for either housing or stocks. The central rationale for stocks are profits. It's growth of the economy. That's the central rationale for stocks. What's the central rationale for housing? Household creation. Growth in population. And the ability to pay, jobs. Those are the central rationales for both of the markets where the Fed hoped to have this wealth effect. I would say if you take a look at the economic growth over the past 5 years, the wealth effect is marginal for all the Sturm and Drang. That means, what does that mean? It's German. It means storm and, let me speak German. I shouldn't quote a language that I don't speak. Anyway, of all the endless discussion about quantitative easing, when you look in a historical sense, you'll see that the effect is marginal. It's not very strong. Of course, the counter-argument to that is the counterfactual argument, the one we've been hearing for years now. Well, it would have been a lot worse. There's no way to prove that. There is no way to prove that. That's the weakest retort to a discussion in a area or a supposed science that's supposed to have some sort of ability to prove or disprove ideas. That's the weakest response, but it's the only one they have. So the effect of quantitative easing is effective at the margins. In stocks, well, you can't get any return You can't get 4% on a 10-year. You're running a hedge fund. You've got to get returns. Where do you go? You go everybody else. You go to the stock market. There aren't that many choices. Housing. Yes. If you're right on the borderline between deciding on a new house, we just actually, and I can speak for this from personal experience. We just went to contract on a new apartment in Manhattan. I have 2 young kids. They're both 5 years old, and they're twins. And we wanted a larger place. Well, what are we looking at? We're looking at a housing market in New York that seems to be driven by 2 things. One, the lack of available housing. But how can there be a lack of available housing in a place like Manhattan? Because people aren't willing to sell or don't feel that they are able to sell now because they're not sure about their financial conditions. So, because interest rates form a decision factor on the margins. Now, for spec people, for people who are buying all the houses, the endless tracts of houses that were built in Vegas, interest rates are an important factor. And the Fed's well aware of that. So for certain types, as an auction I used to go to, the auctioneer would always say, bought for resale. For certain types of purchases, cash purchases for resale, interest rates are an important factor. They're less of a factor, although not unimportant, for the type of housing growth that is long-term, effective, and stable. So, Fed policy as far as interest rates goes, where it's hoping to have its effect, the wealth effect, stocks, primarily stocks and housing, is effective at the margin. Okay. Second point. The Fed chose QE not because it's effective, because they had run out of options. We really discussed this earlier, but I just wanted to mention it again. No one on the Fed, I don't think, was pretending that this is a new, brilliant discovery. Yes, it might be. But, you know, as you all know, I'm sure many of you, own houses. A house is a lot of work. No matter where it is or what it is, you work on a house. I happen to like doing that. I consider it relaxation, but it's still a lot of work. So we decided not to go that road and get a townhouse. But I thank you for the consideration. It's pretty funny. The place we're moving has this enormous roof. Well, yes, if you want to know what keeps you young, have 2 kids. That'll keep you young. And to knock wood, of course, in New York City, there are such things as co-ops. I'm not sure that you're all familiar with them. But it's an interesting way of living because you are basically approved by your fellow owners in a building as to whether you're allowed to move into the building. And even in as litigious a society as the United States and New York, no one has ever broken the covenant that a co-op board has to explain their decision. They don't. It's been attacked many years in the courts. And so, for instance, I'll just do this briefly. Sorry, I don't mean to get off track. You all know I do. We have to go to the board and get approved, and the board has to vote and say whether or not we're allowed to buy in the building. This is aside from finances and aside from the fact that the current owner wants to sell to us. That decision is in private, and it cannot be attacked. No one has ever been able to take a co-op board to court and say, why didn't you sell me the apartment? I had enough money. So anyway, that's what we're dealing. So, although it is kind of interesting. So anyway. Okay, so the second thing about QE is that the Fed chose it not because it was effective, but because they ran out of choices. Within their mandates within the Fed mandate of inflation and employment, they felt that they had to do something. You know, Mr. Bernanke was a student of the Depression, and one of the things that he learned from that is that Fed inaction can be done. And so with that in mind, the Fed came up with quantitative easing. The third difference of quantitative easing, and it has a lot in common with regular monetary policy here, and that is, as someone mentioned on the chat, let me see who mentioned it. I'd like to be specific. As George mentioned, yes, bubbles. Now, many people have said, now this is something you can have in common with regular monetary policy, interest rate monetary policy. Many people would say that the housing bubble from the early and mid part of the last decade was due to the Fed keeping interest rates far too low for far too long, which ran right into the subprime market. Of course, there were many other factors. There were government policy promoting housing. There were lots of factors involved. But certainly one of those factors was the availability of money. You are seeing this now. I am not convinced by any fashion that the level of the Dow or the rest of the equities is anything, and it's very difficult to quantify this, but let's put it this way, is a large part of it is due to deliberate Fed policy. The Fed has said this a zillion times. Wealth effect, wealth effect, wealth effect. Okay, what happens? Stock market goes up. Of course, the other side of that is that when the Fed finally does change policy, do you reverse the effect? And if you do, then what is the effect on the economy, which of course is your original concern? We'll talk about that in a second. Okay. The last factor of quantitative easing, I think, which is unique to the situation, is that it acts as an enabler for bad government policy. Now, the dates are not really QE dates. I call them QE. They're the dates of Fed discussion. I'll tell you what they are right now. May 22nd is when, I'm sorry, I should have finished that earlier. May 22nd is when when Mr. Bernanke first mentioned it. June 19th, he seemed to reaffirm it, that they were going to stop. July 10th, he seemed to walk it back, that maybe they weren't going to. And then September 18th was the FOMC meeting where the Fed did not commence to reduce QE, surprised everybody, including me. I wrote a long column a day or two before saying 6 reasons why the Fed will start to taper, and they did not start to taper. So the period through here, where even from July 10th up to September 18th, even though it seemed the Fed had walked back a little bit, I don't actually like that phrase very much, had said, no, maybe we're not going to. There's my mouse here. Come on now. See, there we are. And it's similar to what we're seeing now, better than expected economic statistics from the United States kept the market on the idea that the Fed was going to taper. The whole thrust of this period right here, from May 22nd to September, was, and up here we're talking about profit taking, of course. This is not a pure motive chart. Of course, nothing can be. The primary idea behind all of this is the idea from Mr. Bernanke's tenure and also Fed history. When the Fed starts to talk, it's for a reason. The Fed does not bring up quantitative easing tapering without intending to do so. That's the basic rationale behind that chart, why rates went up. Now, they got surprised, but they're still on it. And we're still on it because, as the Fed says, we're data dependent. It's getting a little better. So anyway, back to the government. So the last part of quantitative easing, which works or the effect which is not true from regular monetary policy is that it gets government off the hook to do anything. It's an enabler. INDU is the Dow Jones Industrial Average. I have not read Mr. Ponzi's book. I know Mr. Ponzi, but not very well. But I have not read it. So this last effect for government policy is one which the Fed has spoken about, Mr. Bernanke has spoken about in relatively discrete terms, but it nevertheless remains true. If the Fed had not driven rates, 10-year rates, other rates, to the levels that it did, it would have been far more expensive for the federal government to run 4 years of trillion-dollar-plus deficits. $1 trillion is a lot of money. And it was if rates were double, rates were historical, it would have cost the government, billions and billions of dollars more to run those deficits. There's another problem with those deficits now that they're standing there. They're primarily short-term. The Treasury went out and did short-term. Why? Short-term's cheap. Those rates all have to be rolled over. Okay, so now let's talk about what the Fed can possibly do. The Fed, in surprising everyone on the 18th, has said. Now, part of the problem here, I think, for the Dow is that the statistics, if you look at this chart, you're going to say, okay, on the 18th, the Fed decided to keep rates low, but the Dow went down. I think what you ended up here were two things. You ended up with some profit taking, but the rationale behind it was that, wow, what does the Fed know? And through this period here, we saw generally worse than expected statistics out of the United States. So what the market is looking at is saying, well, things are worse than we thought. Good time to cut some profits. That's somewhat part of the logic here. And here we're seeing the reverse. So the Fed's, I want to get up another chart. I'm going to take away this one, and we're going to talk about the Fed's dilemma. I could have called this the Fed's dilemma, but I didn't. Okay, where's the 30-year mortgage? Okay, this is the 30-year mortgages from Bankrate.com. These charts are all courtesy of Bloomberg, my soon-to-be ex-mayor in New York. Okay, remember, where the Fed hopes to have its most effect, so the three areas I'm going to look at here as far as the effect of quantitative easing up till now and going forward. Tapering specifically. What's the Fed going to do? And what will be the likely effect? The two areas that we mentioned for the wealth effect, of course, were housing and stocks, or housing and equities. Well, let's take a look at some of these charts and see what we see. Okay, the bank rate chart. We went from about 3.4 up to 4.67 right here. What you'll find interesting is take a look at this chart. This is existing home sales. Okay, it's a 5-year chart because the other chart didn't look very good. But take a look. That's when Fed started tapering talk. Didn't have a lot of effect, did it? Rising rates, we can take a look before. Let's change this chart for that chart. Okay, let's take a look at this is, and now we're looking at 30-year mortgage rates. Okay, so this is 30-year mortgage rates. If you're looking for a direct, you would say, you see, part of the thing that we have to be aware of is because we're in the markets. We're looking for direct effects. We're used to direct effects. The Fed comes out and says something. an unexpected statistic, and the markets react. Currencies especially, equities especially. It's an immediate reaction, instant gratification, if you will. That's not true for economic stuff, of course, as we all know. And we're seeing that kind of a discussion here. I mean, the rates were rising from May all the way through, let's say, September. But there's a delayed effect in housing. You take a look even more. This will bring the delay back. This is pending home sales. Pending home sales are contracts signed before closing. A certain portion of them never go through, primarily because people are unable to get mortgages. Okay? So we can see a much greater effect here than in here. Take a look at these two charts. Remember the difference here. There's a delayed effect in housing, and it's very, very evident here. Because if you are looking at this chart here, that's pending. These are contracts signed, basically, and these are sales. These are closures. And the reason for this difference is that closures in May were signed 2 months earlier, by and large. And these are new signings. And you can see that new signings started to decline when Fed policy seemed like it might change. Now, the numbers here are much smaller. These are millions, and these are in the 100,000s, just so you know. Okay, so for the housing effect let's take one step back. What did the Fed tell us when it did not do what it had led everyone to expect it was going to do, and that is begin to taper? What did it tell us? It told us that it feared the effect that tapering would have. What does the effect translate through? Of course, it translates through interest rates. Okay? Let's go look at the 10-year chart, which is the key of all of these charts, right? It's basically the crux of everything we're doing here everything we're talking about is based on the 10-year. I mean, it's the best signal, okay? So, when the Fed did not taper, it was telling us that the economy was not strong enough to withstand, or it was worried about the economy's ability to withstand higher interest rates. It was also, I think, telling us, and this has come out somewhat in the minutes, so very discreetly. You won't get the unedited minutes for 5 years or 10 years. I forget how long it is, so we're never going to know. At least, and none of us are going to remember to look it up. That the Fed was surprised by the rapid rise in rates. This, I admit, boggles me. Having been involved in the markets now, various types for 25 years. Let's say that very quietly. 25 years? It is, since I got out of grad school. It's a market view, the way markets deal with information is very natural to me. It's natural for the markets, but it's not natural for most other endeavors, most other venues. And apparently that is true for academically trained, successful central bankers. It seemed from the minutes that the Fed was surprised that rates were rising so rapidly. And I think as much of a concern as the Fed had about its effect, the effect of interest rates on the economy, I think it was very much concerned that the markets would take it too far, as markets always do. Markets always overshoot. And so I think the Fed was concerned back through here that if it started tapering, you would see the 10-year at 3.5% and 4%, which after all is the historical norm, very, very quickly. So there are two factors here for as far as interest rates go. One, of course, is the absolute level that the Fed was worried about. And two was the speed of the change. But we all know from trading, and this is market knowledge, market view, that he who moves first makes the most profits. And that's, of course, what's driving all these markets, driving all markets. So the idea that the Fed was surprised by this surprised me. But apparently that was the case. So the Fed had two concerns. The first was the overall economic concern, that the economy really might not be able to stand it. But I don't think that was key because, the economy, the statistics, the econometrics, between May 22nd and September 18th had not deteriorated very much. We put so much emphasis on what are marginal changes, marginal differences between what's expected and what's actually delivered on any particular statistic, that we heighten the actual economic information that's contained therein. There isn't that much, let's put it this way. Between 160,000 non-farm payrolls and 204, there is minimal economic information. Minimal. Especially if they both fit into some general trend. So the idea that the Fed was, overly concerned about its effect on the economy, it seems to me to be less of a factor in their decision than in the speed that the market had changed. And that that effect, the rapid effect, might actually be worse. Okay, so we have the Fed now concerned about the effect of rising interest rates on the economy. And we have a rapid change of policy. So now looking at the situation right now, let me just check these questions and make sure I've read everything here. Yes, I'm going to talk about that in a second, as far as the last question there. Now, the Fed claims to be data dependent. Okay, let's take them at their word. They're data dependent. They're trend dependent is what they are. They're looking at trends. And as I just said, the difference in statistics from early May until July through September is minimal. It's really not that big. It certainly doesn't seem to be enough for the Fed to change its mind. After all, the Fed changed its mind. Now, they did say in the minutes that the vote on not tapering was very close. Or the discussion was very close. I have to check the minutes and see exactly what it was. Okay. So where are we now? Let's start from the top. The institution, has recently backtracked on its own policy. It had said, and it brought up on its own initiative, that we're going to start tapering, perhaps. And then it went back on it over a period of, May to June? Over a period of 4 months. A trivial amount of time in the long run of monetary policy. So the Fed had made a great deal under Bernanke, and actually will even more so under Janet Yellen, of transparency, of letting the markets know what it's going to do, so the markets aren't surprised. Well, the recent gyrations of the Fed, which absolutely shocked the markets on the 18th, does not seem to be in line with its current policy, official policy, of transparency. So you have that weight against any near-term change. You also have continuity. The Fed is generating a tremendous amount of volatility in the markets, not something it wants to do by going back and forth on policy. 3, you have Ms. Yellen. She's actually from Bay Ridge, which is where my wife is from, in Brooklyn. She went to public high school, Fort Hamilton High School out in Brooklyn. And when she went there, it was a relatively rough area. So she's quite an accomplished woman, something to be very proud of, actually. But historically, her view and what she has said, and this is probably why the the hearing tomorrow is worth listening to. I'm sure it'll be broadcast live, at least for Americans, is what emphasis she puts on it. She's not going to come out and say what she's going to do, of course. But the more time she mentions employment, the more time she mentions economic growth, the more likely it is that the quantitative easing policy continues. But her bent, her emphasis has always been on the economic side rather than the inflation side, on the employment side. So that is something which people are factoring in as well. The third, of course, is the effect of rapidly rising rates on government debt. I don't know how to categorize this one because it matters whether or not let's put it this way. About 70%, I believe, of new issued treasuries are purchased by the government. That means if the Fed stops buying treasuries and the deficit doesn't change, somebody else has to step in and buy those treasuries. And if they're not willing to buy the treasuries at the current rate, then the rates are going to have to rise. If there are no bids in the market, then the sellers will have to lower their offering price. So that's the last factor that's involved. That will undoubtedly raise costs for the federal government. And to pretend that the Fed has now interjected itself directly into the functioning of the federal government. This is another, and probably I think the most dangerous effect from quantitative easing. It becomes a factor in the finances of the federal government. As before, Fed policy was dictated by the needs of the economy, not by the needs or even the consideration very much of the needs of the federal government's own finances. But quantitative easing has put the Fed right in the middle of government policy and in government financing. That's another issue for the Fed. And to pretend that they're not aware of this is not realistic. So where are we left? The economy is a bit better. It's certainly a bit better, but it's marginally better. I mean, I didn't bring did I bring any charts on non-farm payrolls, which is, of course, what we're all looking at? I don't think I did. So I'll have to deal with it. We all know. The 3-month moving average, I believe, in non-farm payrolls has moved up to about 200,000, which is about where it was at the end of last year. It came down through the year. In the second quarter, it down to about 180. So when the Fed was considering, okay, I'll end in a minute. When the Fed was considering and came to the policy, which it announced on May 22nd, of tapering QE, the job creation was lower than it is now. But again, 20,000. 20,000 is not a significant indicator of anything in non-farm payrolls. So we have an economy which is marginally better. We have a federal government dependent on the Fed to some degree. And we have a Fed board, governing board, which has recently reversed itself, has a new head whose focus has always been on the economy, not inflation. So where does this leave us? I know that the run of relatively better statistics over the past 3 weeks, since October 23rd, I believe, has led to increased speculation, or at least increased comments, that the Fed will taper QE in December. I do not believe it. As a matter of fact, I do not think that the Fed will taper until even begin tapering until the end of the first quarter. Now, I was also dead wrong on September 18th, myself and everybody else. So I'm no longer so sure, but I would have a very hard time thinking that the Fed will reverse itself yet again after not doing what was expected on the 18th to reverse itself yet again 8 weeks later, I think is a bridge too far for the Fed, and certainly a bridge too far underneath Janet Yellen, assuming, of course, that she is confirmed, which I believe she will be. Okay, folks, I will end here. It's a little bit after 12. That's about an hour. I thank you all very much for attending. I hope this has been instructive, interesting, maybe not particularly funny, but we do the best we can. I will put my email address on the chat. If you have any comments, considerations, criticisms, requests, please let me know. I will be glad to respond to them. We will be doing another webinar, I believe, on the 24th. I'd have to check the date. And that will be a trade preparation webinar in which I will discuss how one arrives at a particular trading decision. I do those once a month. I think they're a lot of fun. And I do them live. In other words, I just bring up a chart. I do look at the chart beforehand, and I go through exactly what I would do when I was sitting at a trading desk, which I did for about 15 years. I thank you all very much for coming. I consider it a compliment to myself and to FX Street that you take the time to do this, and I wish everyone a very good day. Thank you.